UK founders are hearing different versions of stories. Is there still capital out there? Is it more difficult to actually get capital now? Those questions are coming more and more fast forward. But what type of bets are investors now taking? What type of markets and industries are they actually looking at? And where is that actually going? And that's the discussion that I'm going to be sitting on today. Stephen Johnson is a fund principal at Mercia Ventures. Stephen, thank you very much for taking the time to sit with me today.
Thank you.
I have come across some of the brands you've backed, Oddbox, Pure Pet Food, really interesting industries that you've also got into, AI, robotics, and quite diverse markets that you guys have invested in. The conversation that I really want to have with you today is to look at, you really go into hard market sectors, not everyday type of SaaS products. You look at the end goal. And the discussion that I really want to have with you today, Stephen, is to understand what you look at and what you need to see to know actually the vision is actually going to come to life from this. So it'll be great to have a bit of an introduction from yourself, and we'll get straight into it.
Very good. Thank you for having me. Yeah.
So
I'm Stephen, fund principal for the Northern VCTs. So Mercia is a house. We invest from seed through to Series A, typically investments from 1 to 10 million in early stage UK-based companies. So I run the slightly later stage fund in that grouping. As you say, we invest across different sectors. So the 4 key pillars of what we look at. So software and AI is a big pillar. Consumer, health and deep tech, sort of the final 2 bridges, and life sciences folds into health. And what we look for in each of those different categories varies. So software tends to be more scale-up investments that are on the journey. They've got some semblance of product market fit, and it's about taking an early stage company that's typically quite reliant on the founder to continue to grow, and it's about building out that next level of executive capability in the business to allow it to really go on and become a true scale-up. And then other sectors, the health and life sciences tends to be more about taking propositions through some form of either proof points and value milestones into sort of regulatory clearances. And then consumer tends to be more similar to software, where it's about a product that's starting to resonate with customers, and then it's about going quicker and really trying to build a big business.
Makes sense. Well, I think it will be great to probably start at the beginning of all of that, really. I think the first question that I really want to get into is where capital in the UK is actually moving right now, because it seems it's, for me as an entrepreneur, having raised funds from different angles of VCTs, PE, EIS funds, for me as an entrepreneur, I just feel that going back a couple of years, it was a little easier. There was more risk appetite. Now valuations are slightly different. Risk appetite is slightly different in the UK market, I'm finding personally. I guess the first thing that I want to really understand from you is, where do you sit on that? Where do you think, has capital moved, or is capital still there? Is the profile of investments different? What's your thoughts on that, Stephen?
Good question. So I think you're right. It has changed, and it's changed for a few reasons. So I think obviously the interest on the supply side of capital, the interest rate environment has changed. So you had a very long period of near zero or near zero interest rates, which obviously drives proliferation of capital. Funds are raising more money. There was more money to be sort of deployed and raised. And you had lots of mega funds, well, not just mega funds, but at all levels, right from early stage venture to late stage venture to PE. And then the public markets were sort of roaring through the 2021s. You saw huge numbers of IPOs. Yeah. And when, I think the best analogy is thinking of it like a river. And when the river's flowing really fast, right the way through all of that capital stack, the more things that feed into it, the more flows through. And generally there's just this sort of positive flywheel that things move quicker. And it started pretty much with the IPO market, and then interest rates correcting. That all just started to slow down a bit. I think running counter to that is, as you'll be well aware, the rise of AI, and that's the new frontier of sort of business and the new platform. You had previous eras of SaaS, mobile, and then is AI the next one? It's looking like it is, and it will continue. So that's run counter to what would have been a relatively tough environment in sort of previous cycles. So I think it's a combination of tightening in interest rates and then the sort of the flow through from all that. But I think that there is still capital out there looking for homes. As you say, I think when things become tighter, it's just naturally a flight to quality, that people only want to back things that they feel really confident are going to deliver returns.
Of course. Have you seen that as an investor yourself, have you seen that spiral where it's actually at that bottom tier now in some ways I've seen it to where, as you say, a couple of years ago, a lot of companies were IPOing, ridiculous valuations. We've gone through that phase of different markets came very quickly, fintech came, health tech. We've seen a lot of industries move very fast. We are moving into that AI, but AI seems to be so revolutionary that it's going to impact a lot of other companies that could go out of business if they don't adapt it. But it's really interesting from an investor's perspective of how do you know what to back? Because Mercia has a lot of different types of investments, right? You guys are in consumer tech, you've got B2B opportunities, wide range. How does that sit within your portfolio?
Yeah, another very good question. I mean, it's the interesting thing with AI in particular is whether it's software, whether it's AI, ultimately the purpose of all of these businesses is to help someone else do something either quicker, better, faster, cheaper, automating work. So whether it's a software workflow tool that enables someone to structure and manage their work, or it's an AI agent that does it on their behalf, takes an input, does something, creates an output, and what they're all trying to do is kind of do more work and automate it and do it as cheaply as possible. So I think for technology as a whole, it's still a great opportunity. I mean, you could argue, and some of the sort of questions that are being raised, I think globally, are what's the impact on labour as a result of this, in that work that was previously done by workers and people is now potentially going to be automated. What happens to those people? Historical trends have shown that actually humanity always finds a way to find new work to do, jobs that didn't exist 20 years ago, now huge industries. So you can take some comfort that history has taught us that those things will play out okay, but there's certainly some signs, particularly junior level hiring, is down. So I think it's going to be an interesting few years to see how it plays out. But as you say, there will be disruption, but I think overall, this is a really positive trend for technology businesses as a whole, because there's more work for those businesses to do, so therefore more opportunity.
I'm going to take an example of an investment Mercia made, and I think it was something I read about, Endreams, a VR company. Very forward thinking. Probably when you guys invested, it was still going through that vision aspect of where it could get to. When you look at examples in industries like VR, where the founders have to have a lot of resilience in some ways. I remember when I started out the GP service, it was like in this country trying to get a patient to see a doctor via video conferencing. People ringing up and saying the doctor's not turned up to my house yet. It was, you really need to believe that in a few years' time, this is where the market's going to go. Yeah. When you make an investment into a space like VR or AI, where the market isn't fully ready, but you can see that, as an investor, what do you look for? And also, what do you look for in the founder from a resilience perspective? Because there's got a lot of setbacks when something doesn't exist and you're trying to convince someone it's going to work, right?
One of the best bits of the job is getting to work with founders, because it's quite an infectious energy, because it does take a certain type of person to have the resilience you need. It's daily firefighting. So, I mean, taking the second one first, I mean, what we look for, I mean, it's as you describe, it's founders who either they know what it takes and they're still going to do it anyway, or there's sort of a bit of potential ignorance in that they don't yet know how difficult it's going to be. But as you well know from being a founder, it's brutal.
Yeah, exactly.
Every day there's something to solve. Even when you think things are going well, there's
always fires.
There's always a fire, and
there's always fires.
Even companies that look like it's nice up and to the right, linear all the way, even the best companies, it never is. I think that finding people who've got that resilience, and we spend a lot of time getting to know the founders on a pretty human level around, what's motivating them, why have they founded the business, what do they want to achieve. And through that process, you get to know, what drives them, and is it someone we think we can work with? And likewise, do they think they can work with us? Because that's equally as important. So on the market question, I think it's a combination of, you need to be able to see a future that can happen, that isn't going to happen. but I think grounding that in what has to be true for that to come true.
Yeah.
And it might be based on, market growth. If there's an existing market that you can sort of qualify and say, well, that's how big that market is at the moment. This is a new way of doing it. Therefore, in the future, we think this is how big the prize can be. So VR would be a good example. You've got a huge gaming market globally. This is the new platform or medium through which people play games. Therefore, it's possible for it to get this big. Obviously, VR hasn't become sort of questions at the moment, particularly with Meta at the moment on the future of VR. But you can use comparables like that in other businesses. We'll look at, I guess, having comfort of how big could the market become?
How big the market
in the
could
end.
become,
But there's an element of art and science in doing that. So you use the science of, we think in the future this product or service you'll be able to charge this much for it. There are this many end customers who we think will be attracted to it. Therefore, if everything goes well on an upside case, this is how big the prize could be. So you can do that, but ultimately, there is, when you're opening up new markets, creating new categories, there's so much needs to happen for it to go right. There is always risk, but we're in the game of taking risks.
A lot of investors that I sit down with, usually have markets that they want to invest in mainly. It could be SaaS, it could be B2C, B2B, whichever way around it is. When I look at Mercia, it's quite broad. If I take the examples of Earth Rover, they're in robotics, Scalpel is in medical AI. You are quite broad in the type of intelligence that you require as investors because it's so broad. How do you actually build out a team that can actually meet with the founders on the level that you can really understand the details of the market that they're in?
Yeah, it's a combination of having an adaptable team. So I'd say within the team, there's individuals who are very adaptable, and there are some fundamental, I guess, truisms and consistencies across all of those sectors. The two examples you gave, they both take an image. Earth Rover's in the form of video, Scalpel's in the form of an image, but they're both taking an image as an input, running some algorithms over the top, and checking what's the output, and then making a decision or providing a signal to a downstream system as a result. So there is quite a lot of commonality between the two. So I think when we're evaluating businesses, there's three aspects. There's team, product, market. Team, that's probably the most critical for us, I would say. That's what we care about most. Is this a team we think have the capability to go out and deliver the outcome that they say they're going to, and we think they can? The product and technology, and that's where I think we have individuals who specialise in particular areas. So I came from a software background prior to venture. There's others who've worked in the life sciences industry in different capacities. We've got colleagues who've been entrepreneurs as well. So people from different backgrounds, but I think not just relying on our own judgment. We will always go out and talk to others in the industry, whether they're people in our network, or we'll reach out and find people who aren't currently in our network but can help us make an informed decision.
Fantastic.
So we won't just rely on our own judgment. We'll take lots of inputs from the wider industry and use that to inform the decision.
I see.
But again, and the commonality I would say between all businesses, developing the product, and often a lot of these products are very complicated and sort of sophisticated to build, but that is only half the battle. And again, as you'll well know, sort of make the product and service, but commercialising and selling it is just as hard.
Just as hard,
And that is really understanding the incentives in an industry, because you have a product which intuitively makes huge amounts of sense. In healthcare, for example, it helps patients, prevents illness, whether it's chronic or acute or whatever. But actually, if the incentives of the industry don't align to helping those patients, so it might be you've got a new diagnostic that's going to identify lots of patients, but if that's going to overwhelm the health system, then even though it's bad to say it, the hospitals and health system perhaps isn't going to be up for
using it as well. Exactly.
So you've got to think through, there's so many aspects, and that's just one example, but in each industry think through what the commercial dynamics are.
Absolutely. That probably takes me on to my next question, which is founders are very passionate about what they're building. And what would be your advice around what founders underestimate in these type of hard markets where they're trying to drive innovation? Because you're trying to launch something you think is of real value, the hospital may think it's great, but it's too risky. How do you try and bridge that gap, in your opinion? How do founders try and bridge that gap, and what do they underestimate?
Yeah, it's literally the $100 million question, isn't it? Because every business, that's the challenge they face. I think that is the biggest thing I think people do underestimate is every time you reach a milestone, you're getting your first customer, first million revenue, and then every milestone from then on, each level presents new challenges. But I think truly commercializing a technology at scale it's so difficult. It varies hugely by industry. We've seen particularly the AI products that have come out recently. There's immediate payback for the users, and if it's applicable to a huge audience, you've seen some phenomenal flywheels where companies have managed to grow very, very, very quickly. But when you're selling, particularly into a B2B customer, and that can be across healthcare, can be across software, but when you're asking someone to commit either to a big investment or a big amount of business change within their operations, and they're going to have to change what they're doing. There's so much work needs to go into thinking through the buyer journey, how they're thinking about the product, and sort of all of the downstream things they're going to have to do if they're going to adopt your product and it's going to be successful. So I think there's things that intuitively make sense, and in your mind as the founder, you might think logically, why aren't people adopting this? But I think seeing it from their perspective and helping them to sort of see it from your perspective as well.
Absolutely. And that probably takes me on to you as investors when you are meeting with founders. If two founders look very strong on paper, and once you are meeting with founders, what kind of attributes do you look for that make you feel that we want to progress this conversation, or this is someone we can back?
It's a combination of, as you say, the dynamics in the meeting. Usually you get a gut feel in a meeting. It's people who are very, very, very clear about what they want to build and why. And again, that comes through, I think, in just how simply people can explain things. So when a founder can clearly articulate in one or two lines what they're building and why, and it immediately resonates, you think they've thought about it so much that they've been able to synthesize it down to such a simple statement. And then throughout any follow-up question you've got as you go into more detail, it just rolls off the cuff. I think that's evidence that they've either experienced the problem themselves in a previous job or a past life, or they've deeply studied what they're building. So that's a huge signal. Evidence of resilience, as we talked about earlier, it is daily firefighting. So someone who's got the capabilities to deal with that and everything that's going to come with it. And we do some referencing, so we'll try and find out about what's the person done before, get to know people they've worked with in the past, and generally that you put all those signals together. Meeting people in the wider business as well, sort of when you meet others in the company, how do they behave around the management team or the founder or the founders? Is there a good dynamic? Do people look up to them? Those sorts of signals are that this clearly is a leader that people respect. They're going to be able to attract more great talent into the business. It's a combination of all those things, but this one really is an art rather than a science, I would say.
Absolutely, and I think that's a really important statement there. Actually, I always believe that's the biggest. It takes a long time to learn and adapt, but it's your people that build the success of what your vision is, really. And you got to trust the people, and you got to bring in good people. And it's like Steve Jobs kind of says, you got to hire people better than yourself. And for myself, I've learned get out the way on the areas you're not very good at as well. So
I think when I first started in venture, someone gave me the advice. It's all about the people. And you sort of write it down and you think, okay, it's all about the people. And then way fast forward from that point, I realise now on a much deeper level, it is all about the people. It is all
about the people. It genuinely is all about the people. And I couldn't agree more with you on that. I think when I learned that and started getting out the way of, I learned in my own entrepreneurial experience, I think I'm a great person to set the vision, great person to understand the plan of how it's got to get there, but delivering that plan from an operational perspective, I could confuse the hell out of my team because every day would be something different of how I see it. And then I learned actually having a strong COO, for example, that can work with the team and just focus on that plan, whilst you can focus on the ideas, managing investors. You're actually getting the best out of yourself. So I think for me as a founder, it's really important to know what you're good at and not be scared to understand what you're not very good at. And I think a lot of founders, I find, just want to be good at everything. I'm not sure if it works all the time.
You bang on in the assessment, and it's having the self-awareness to know, particularly as a business scales as well, you can't do everything. But I think the sort of the journey founders have to go through is most of them found a business because either they see a problem they want to solve, or actually they want there's an element of wanting control over everything, and that's why they're not working in another business where there's sort of constraints they have to work within. When you're a founder, it's all you. Like, you've got total control over everything. So I think the reason people are attracted to that is that as it scales and you have to relinquish control, it's a tough.
Do you think founders make good CEOs?
I think they can. They're the same thing in a way. I think every founder has to go on a journey of partly figuring out what you're good at, partly learning on the job and learning as you go, because being a CEO is, it's a huge job. There is so much to it. If you write down, and we do this when we're sort of evaluating teams, you've got frameworks for what is part of being a CEO, and it's a very, very long list of things that they have to do. So to expect one person to be really good at all those things it's rare.
See, I've worked with a lot of founders, and I find that some are great with the vision, the product, but have no idea when it comes to the P&L or the financial sides, or how to operationally manage some areas. I think my own learnings have been what you as a founder are your key strengths, and work within those remits, and where you are struggling or what you don't have, don't be scared to bring that talent in.
Yep, 100% agree. Yeah.
I have one very interesting question for you, which is something I've seen a lot, and I don't know how you feel about this, but when you meet a founder, how do you come across if you believe they genuinely are going to be someone that's coachable, that's going to be someone that's going to drive what they're doing, compared to they're just trying to get the check?
Yeah, I mean, the stage, it's a good question. I mean, probably one for more of a seed investor, I think. But I mean, for the stage we invest at, we look at the track record in the company. So sometimes if we've met a company for the first time, then it's all about intuition really, and what do we think. Ideally, I mean, not ideally, but often we'll meet the same company over multiple times, and if they, through the conversations, we'll get to know the founder, get to know a bit more about the business, and if they consistently do what they say they're going to do, I mean, there's no bigger evidence than that, and that's a really great signal.
And I think that's one thing that's really important, what Stephen's saying there actually, is because I found throughout my career that investors that I have only been having chats with or coffee with or in passing, but meeting at networking events, just chatting through what you're doing, there is no objective or agenda of talking about raising cash or anything like that, but you're just having those couple of minutes touch points, and as you meet the same people more, you end up building that rapport and relationship. And for me now, whenever I take investment, it's not fresh, it's not I'm going to write cold to someone and go, I'm looking for investment. It's coming from a network that you've built. And I think one thing for founders is the power of networking is so important. And just telling people what you're doing and then being able to follow up in showing you've achieved that gives a lot of confidence to the people you're talking to as well.
Yep, 100%. I mean, and in the earlier stages, investments do take more of a leap of faith from investors. Once companies get to later stage and there's evidence of a company continuing to grow and a team that's consistently delivering, it's more of it's a different type of evaluation for investors. But at the early stage, when you're backing the team, the more you can build relationships with people, the better, I think.
I've got one question that's come to my mind, because I did this I remember when I first raised cash, you've got that excitement at the beginning of it. Tell me, in your opinion, Stephen, what do the strongest founders do in the first 90 days compared to what you believe will end up being the weaker ones?
Do you mean post-investment?
Post-investment. Can you feel that at that point?
Yeah, I think.
Because I think I've made my, like when I look back myself and I look at it, okay, I remember when I raised VCT funding for the first time and I went, okay, the plan shows we can take a nice office, do 1, 2, 3. That's when I look back now, that was all wrong. Even though you've got the cash, in my opinion, it should still be very lean and going after where the proof is in the validation of your product.
Yep.
But I do find, and it happened very early, if you remember the health tech space a couple of years ago, a lot of companies raised a lot of money. We had Push Doctor, Babylon, Dr. Han, many, and everyone raised between 20 to 50 million, large seed, Series A rounds. And a lot of money went into offices and things like that. What's your opinion on that fact of what should founders really focus on in their first 90 days after raising cash?
Yeah, I mean, the first 90 days, I mean, typically fundraising processes they can be quite taxing. Depends on the approach founders take, and it can be sapping. So I mean, sort of taking stock, getting ready, going again. I think the best founders, they manage to keep momentum in the business throughout the fundraising process. It's easier for later stage companies where there is a wider executive team who can do that. But I think you want to avoid the situation, particularly if you're in a scale up stage where you're looking at your track record and growth rate. You don't want to be you don't want to see a blip while the fundraising is going on. Ideally, the momentum keeps going, which is difficult. So I think first 90 days, it's about, agreeing, and it's useful to do with your board and with the investor group, and hopefully this sort of happens as part of the fundraising process. But throughout that process, you've made assurances and promises to the investors. This is our growth plan. This is what we're going to go and do. So having a clear action plan, and we spend a lot of time with our founders on this. We call it value creation planning. So we'll typically, depends on who's around the table, but we like to try and bring in an external facilitator who is, they don't have any vested interest on any aspect of the business, but they're there to make the conversation happen. And it's about, where is the business going to be 3 years from now? So start with defining that, and then the whole rest of the exercise is to work back from there of how we're going to get there. So what are the milestones along the way to getting there? What input activities or things need to happen for those milestones to be realised? And have very clear understanding both across the executive team and across the board and the investor base, so you're all aligned around the same plan. Like, if a good outcome would be this, and it doesn't have to be 3 years, it could be 2, 5, but where you want to get to, and you all agree, and we sort of try and get it synthesized down into a page, so one plan on a page which has, what are we going to do, where are we going to be, how are we going to get there, how do we measure success, and then you go and do it, and then it's up to the executive team to go and deliver against the plan.
That don't quite make it. It's obviously, cash is important to get you to where you need to get to, but the founding team are the IP at the beginning of that journey. And when that starts going wobbly or not to plan, it can be quite detrimental at some stage. As investors, how do you kind of manage that and look at that?
Yeah, I mean, it's, as you say, we talked about earlier as well, it's never linear up and to the right. Things, and even when things are going well, there's always things going wrong in the business that need to be dealt with. I think the overarching thing that's coming to mind is that you need to, as board members and as investors in the business, we have to hold the management teams to account on sort of performance and doing what they say they're going to do. It's common, I think, natural human behaviour. There's the cuddle and kick sort of phrase that's used. So intuitively, you'd normally give people a cuddle when things are going well, because you're really happy that things are going well, and then when performance tails off, what's going on? Why are you not performing? But actually, you need to flip the other way. When things are not going well, that's when typically founders need a cuddle. They need support. That they have a bigger vested interest in making that company a success typically than you do. So it's not for lack of trying or intent. So it's about making them feel supported, and we genuinely try. We care about the founders that we work with and trying to help them succeed. So it's working with them to understand if something's not working, what's not working, why, try and diagnose it. And it can take a few goes to get at that, because if there's something people, perhaps either it's them or there's something in the business they might not want to admit to, that they're not, the root cause might be something that they're uncomfortable with. So I think working that through with them and building trust, which has to be done way before any of this. Obviously, you need to build trust throughout the relationship. But I think it's working with them to understand what do we need to do here? What's the situation we're in? What can we control? Because sometimes the things that are going wrong aren't in your control. But of all the things we can control, what do we need to do? So it's tricky, but ultimately it's always in my experience just on a human level. These are often very capable, very intelligent people giving their all to build a business.
Absolutely.
So you've got to always have that in mind, and sort of a great deal of humility when you go into these conversations.
Absolutely.
But just work with them to try and solve whatever that they're facing.
I've got 2 more questions for you today, Stephen, and then I'm going to move on to put some questions together to like quick fire round to just put you on the spot. But before we get into those, 2 questions that come to my mind from experience, and I'd like to get your thoughts on this. What do you think about entrepreneurs when you put a board together? How important do you feel a board is, and how do you get the most out of your board that's of value to the business? Mm-hmm. Because I found in my experience, you can have a lot of tick boxes around the table. It could just be the investor that just put people there just to make sure that the investment's going to be okay. But the value of your board that I've now learned is actually having the right people that can help you across different segments. Could be opening doors, could be fundraising, could be introductions, it could be looking at the numbers differently. What advice do you give to entrepreneurs when it comes to the board?
Yeah, I mean, all those things you just listed there, the externally facing benefits to having a good, strong board. So I would agree with all of those. People that can help unlock new avenues for the business. That is a hugely valuable aspect of it. One of the other bits I wouldn't underestimate is sort of the quality of questions and the quality of input that each board member brings when they're at the board. I find just the tone, the way questions are asked, are they, because there's a delicate balance between you want to be challenging and or positive at the board, and it's any time anyone's asking questions or providing feedback or I guess just messaging to the executive team, that will be interpreted in a certain way,
of
and
course.
it will leave them with an impression and a feeling, and they'll take actions as a result of that.
Of course.
You want the actions to increase the value of the business.
But in your opinion then, how does an entrepreneur come into a board to get the most out of that meeting rather than do a show and tell?
I think keeping them forward looking. So I think you don't want your board meetings just to be stepping through how did we do last month, looking through numbers, KPIs, taking questions on it. Circulate those things ahead of the board.
Correct.
Take questions in the lead up to it over email or have calls or whatever, but then make the board more about what is the company working on now, looking forwards, and what are we working on next, and sort of the next frontier.
Absolutely.
But I think the more you can keep the conversation forwards looking, not backwards looking, even just that as a high level principle, you're onto a winner. And then the higher quality the conversation is talking about the future, then that's where it really goes well.
And just to finish off, Stephen, it would be great to get your thoughts on, of course, when you make an investment, you want to see that fruition, do well, get to an exit stage. In the journey of a business, when is that exit path ready? And as an investor, what do you look for when you are making that investment? Is it to try and get an exit in 3 to 5 years' time? VC model could be 3x, 4x multiples. What is that you as an investor look for from that perspective?
Yeah, for us, I mean, the reality of venture capital is that not all companies are going to work out or deliver a sizable return. So the investments we're making, we have to see a route for an outsized return to be possible. And if that's not possible from the entry price that we're coming in at versus how big the business can become, then that's where lots of businesses aren't right for venture capital for that reason. If the founder doesn't want to create that big outcome and the company perhaps can't for different reasons, then those companies aren't suited. I think for us, it's less about when the outcome is, but more about alignment on what the plan is. So if we know that the founder, let's say they want to take it to 100 million ARR plus, they think they can build, a globally defining category leader product, then as long as we're aligned on that being the plan, then we can sort of factor that into our plans, and we make decisions, and we manage our fund in a way that aligns with that. If for example, the opposite's true, where someone says, we want to get to 20 million ARR in 3 years, and then we're going to look to exit because we think the market dynamics are this vendor will want to consolidate, or these vendors will want to consolidate, and we think there'll be an exit route. That's great, and we're sort of aligned around it.
Yeah.
But actually then, if when you get into it, the opposite transpires.
Of
so
course.
Someone says they want to build a really big business, we're going for it, and then the next month an acquisition offer comes in and they just all want to take it and sort of call it a day. That's not great. So for us, it's more about alignment, that we're all aligned on what we want to do. And of course, plans change throughout, but we're clear on what we want to do.
And for our listeners and audience who are entrepreneurs that have raised or looking to start out their journeys, I think Mercia is an interesting fund because you have different types of funds coming in at different stages. I met with you guys 6-7 years ago, so it's been a pleasure that I've been able to sit down with you again today. But what would be your message to entrepreneurs around how Mercia can support, and what does that look like, and how do they get in touch, or what is it you look for when entrepreneurs are starting out as well?
Yep. So in terms of reaching out, I mean, we have a website. There's an opportunity to get in touch, and we sort of get back in touch with everyone who contacts. We're all active on LinkedIn, and our email addresses are available and whatnot. So feel free to reach out to any of us. We invest 1 to 10 million from seed through to Series A and Series B. And in terms of what we're looking for, I mean, it's ambitious founders who, as I say, have the potential and ambition, frankly, to want to go on and build a large business. So yeah, that's the sweet spot for us.
Fantastic. Well, Stephen, I put together some questions for you. So I've not given you these in advance because I thought I'll put you on the spot on these. But here they are. This is based on what I believe really resonates with yourself. So so here we go.
Very intrigued.
Okay. What's the earliest behavior that makes you trust a founder?
Humility.
One thing founders should do more before raising cash.
Clarity. Well, gain clarity over your plan. Know it inside out, and the whole exec team to be aligned around the plan. One
thing the founder should stop the moment they raise cash.
Fundraising? No, I'm joking. Actually, no, that's not a right answer anyway. One thing they should stop doing the moment they raise cash. That is a tough one.
The reason I asked that is because, and we can make this one go into a bit of depth, is because I find that the stop should be trying to do everything at that point. But I don't know if you agree with that.
I mean, the reality is I think if they've hired out, if they're starting to hire out the team, then obviously it's sort of leading through others and holding people to account. But yeah, I think the reality is they have to, they kind of have to keep doing everything. But yeah, you're right, with the luxury of being able to broaden out your team, things like you mentioned finance earlier, bringing in a high quality FD or CFO who can take that off your plate, and the more people you've got who are better at different aspects of the job than you, it becomes like having superpowers, because you've got different arms of people who are able to do work really great. And
of course. Harder to fund right now, consumer brands or deep tech, and why?
Probably I'd say. So I mean, we're actively investing in both. We have live transactions at the moment in both. Probably, and I'd normally say deep tech, but there is a lot of interest in companies that are outside of the norm. Not just software, AI, scale-ups. There are more people interested in. I'd probably still just about go deep tech.
Deep tech, interesting. What habit compounds trust with the board over time, do you believe?
Doing what you say you're going to do.
So important. I couldn't agree more with you on that. If you can demonstrate that board meeting to board meeting, showing what you've done, and even be clear on the problems and demonstrate how you're going to fix them, I feel that does a lot for the board. So I couldn't agree more with you on that one. What behavior most often breaks investor trust, and why?
Probably, I mean, the opposite of not doing what you said you're going to do. That's obviously a big one, and that manifests in different ways. But yeah, sort of, and then extension on from that is sort of the other bits, dishonesty, sort of not treating people well. There's a varied list.
What do founders over-optimize too early?
What do founders over-optimize too early? I think in the early stages, and we're guilty of this as well, VCs. But I mean, at an early stage, optimizing for too many metrics, I think, is.
I agree with that.
There's certainly a rule of 40 gets banded around as a metric, but actually it's quite a high level metric that only really comes into effect when businesses are well past sort of 10 mil ARR. So I think optimizing for too many metrics too early on, figure out what's the real thing you need to care about in the near term, and just measure that. So having too many metrics, I would say.
Yeah. What matters more in long-term tech plays? Brilliance or resilience?
Good question. I can't say both, can I? Probably ultimately resilience, I think.
Yeah. And my final question for you today, Stephen. One piece of advice for founders building hard long-term businesses in 2026.
Keep believing. I think always take feedback from the world. Whether it's your market, your customers. You have to listen, and you can't exist in an echo chamber. But if there are positive signals, and actually the setbacks are temporary or navigable in the long term, just keep believing, keep that resilience, because it's tough. It's what I think is probably the toughest thing there is in the world, founding and building a business.
Absolutely.
So keep going.
Keep going. Stephen, thank you very much. This was a very honest conversation today. It really gives an insight for entrepreneurs that are starting out, that are scaling up. And what I liked about our discussion today is you're an investor that's got a broad variety of investments in different segments and sectors. And I think that's really different to see. So thank you very much. I'm sure entrepreneurs will gain great value from this today. And just wanted to say, I believe that, Mercia are a great fit for entrepreneurs that are looking at early stage funds, or it could be you're later in your journey. But I know from my own experience, because I've had many touch points with Mercia, that they are a very established, well-known, trusted source, and the team here are more than willing to support. And I always found that everyone's up to get a coffee and just chat.
Yeah.
And I think that's what stands you out. So thank you very much.
Great stuff. Thank you.
Thank you.